Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from MarketSite with Nasdaq's Markets Intelligence Desk Midday Update. Helping me do this, we have Brian Joyce, who is on the mid desk. Thank you so much for joining us, as always, Brian. Retail sales data, that was the key this morning, and it was quite a surprise because the consumer really was the bright spot in the U.S. economy.
Yes, absolutely. Well, first of all, thank you for having me. Happy Valentine's Day.
Thank you.
So certainly a big disappointment today. We had the monthly retail sales data come out for December. The headline number was down 1.2%. Ex-auto, it was down 1.8%. Expectations were for flat to up to 0.1%. So certainly a big disappointment. You know, whether or not this is already baked into the price of a lot of these stocks, that's the debate here. And as we see this morning, we had about a 1.6% move down in the XRT ETF. It's an institutionally traded ETF. We know this because it trades about 6 to 7 million shares a day on average. So certainly something that is an instrument worth paying attention to. And we could see that the ETF had about a 28% decline in second half 2018. So what was going on during that time when the data was a lot better? So maybe this was already baked in because now we've already rallied about 18% up to the high made back on January 18th. And so after this about 3 to 4 week consolidation, we opened down today on that bad number, but we're already back to green and on the verge of breaking out of this 3-4 week resistance line. So the price action is telling me that, you know, whether this poor data was already baked in, or maybe other things like the Fed becoming more dovish, optimism on China, optimism on the government maybe not shutting down a second time. Whatever the reasons are, everything baked in together, the XRT is back to being positive after a number that was about at a 9-year low, the worst number we've seen in 9 years for the decline in retail sales. So to me, the price action is telling. When you have bad data, good price action, I tend to lean towards what the price action is.
All right, Brian, let's take a deeper dive in the technicals here. If we take a look from January through February over here, it looks like there's 43.25 to 45.01. That's a key range right there. So as a technician, what does that tell you? Is this the sweet spot where traders think XRT should be trading, or are they looking for a breakout at this level?
No, I would think that, well, what's common here is we had a big rebound off the lows along with the broader market, an 18% move. We went from wickedly oversold to now in the bullish momentum range, as we call this, at the 60 level. At a certain point in time, you see some healthy consolidation. Stocks, indices, commodities, whatever instrument we're looking at, they consolidate usually in two general ways: backwards in price or sideways through time. Sideways through time is a more constructive way. That's what we've seen here. At some point in time, a breakout or breakdown will occur. My bias right now, based on today's reaction to negative fundamental data, is a breakout to the upside. All
right, Brian, let's take a look at the S&P 500 over here. And we've been talking about key internals. That 2750 level was key right here. What are you looking at now in terms of the upside and downside based on where we are right now? Because it's pretty close to that 200 DMA, which you technicians are really focused on.
Certainly, the 200-day moving average, as you can see here, this is really the 40-week moving average, which is synonymous with the 200-day. But this allows us to look at it from a longer time frame. You can see it's clearly defined support line on many occasions, not because I say so, because the market is telling us so. And then when we had a lot of consolidation here in October and November, it went from support to resistance, and we're at that level now again, which is about 2745, 2750, give or take. During this rebound, what really stands out to me is the breadth of the market. We have a new high, new all-time high in the advanced decline line, and the percentage of members trading above the 50-day moving average is now at 90%. Just 6 weeks ago, it was down at 6%, which was the lowest level since the lows we saw at 2011, which was also a period of time where the markets were wildly oversold. So we had a nice rebound here. We're consolidating the last couple of days around that 200 days, really been about a week or so. I do think from here we should see a little bit more upside, but at some point in time I would expect a bit of a pullback. Right now for the upside, if we take you to this next chart, what I would look to is potentially the high in December, which is 2800, or 2815, which is what we saw in October and November. Not only were these the prior pivot highs that we would call them, but we had a 600-point move down to the lows in Q4, a key Fibonacci retracement. There's a number of them, the 50, the 61.8. The final one that I look at is the 76.4% Fibonacci retracement. That comes in at exactly 2800, which is exactly where we peaked back in December. That's what we call a cluster of resistance right there. If we reach that level, I would expect a lot of algorithms to kick in, see some selling pressure there, and have a constructive pullback following this phenomenal move up since the lows of December.
Now, for newer traders who are first looking at fib levels, how accurate are these when they hit? I mean, how does it work for technicians? If you see it go to the 50 retracement or 61.8, do you pivot when you start to see numbers like this?
Certainly. So when we initially hit this 50% retracement level, to me, I was expecting a bigger pullback to come down here. We didn't see that. What I was liking about this retracement level, the 50%, was it coincided with a number of other levels. It was where the 50-day moving average was. It was where the lows that we had seen on a closing basis back in November and back in October. So when you have a cluster of technicals all lining up together, you tend to see price react to that. We actually did see a reaction. We saw a sideways consolidation, sort of like a triangle pattern, but we did not have that pullback, and then now we're extending higher. We now reached the next Fibonacci retracement. Well, we kind of went right past the 61.8, but the next technical was the 200-day, and we've been there for about, let's say, 7 to 10 days or so. So we'll wait and see if we can continue on to the 76.4. We certainly don't have to. I look at them as more as guideposts and guidelines and levels where you could identify, clearly define what your risk reward is.
All right, Brian, thank you so much as always for joining me. And guys, remember to be sure to check out Thursdays with me as Brian joins us with his technical take. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.